bonus, there's consistency between the name and the passport. Very similar to my esteemed colleagues, I started my career in investment banking over 20 years ago, actually in 2001 at UBS in London, doing M&A and restructuring work for 4 years, before moving on to the buy side to also work for a large US multi-strat hedge fund managing several $1 billion and just opened the London office. I was employee number 1 in London, have been on the public side for the better part of the next 10 years between London and Geneva, where I'm still based right now. And I've been with NOIA for the last 2 years now as head of research, so I work across all the 4 verticals, and I also specifically manage liquid alternatives. So what is liquid alternatives? It's a fund of hedge funds that we've created with the idea really that we want to have a portfolio of hedge funds that have strategies that are complementary to what we cannot or do not want to do in-house. And throughout our years on the public market side, we obviously have a large network of people in the hedge fund industry, and we know there's very capable managers and strategies that are usually very niche. A lot of them are not as well known by the investors than others, but they all have very interesting attributes, most of it that they focus on absolute returns. So this is what we're trying to do. Basically, it's an actively managed portfolio of best-in-class hedge fund with uncorrelated returns. So this is very important, it's the uncorrelated part. You've seen the slide already in the next one, but I think it's very important, and I have a slightly different spin on it, really taking the long run. Everyone here probably has some exposure to passive investing, equity ETFs, some bond ETFs, fixed income, and that's perfectly fine. But this exercise here shows that we've really had, since 2009 especially, so from 2009 to end of 2021, actually a 60-40, which is basically just 60% S&P 500, 40% US Treasuries, has returned over 10% over that period. And in real terms, so inflation adjusted, 7%. So this is pretty good, and we could say, if I could do this every year, I can just pack it up and we can go home, and what are we doing here? Unfortunately, it doesn't always work like this. And when you look at these last decades, what the research that this is coming from, which is from GMO, shows that they had one characteristic in common, all the gray periods, is that the starting point was elevated valuation levels. And this is the chart that you've seen previously, where we are in the percentiles for the S&P 500 specifically, and for NASDAQ and generally for large caps in the US, is that the starting point, and actually so the starting point, if we say 2022, which we've gone through a correction, but then we've bounced back up, the starting point is the same. We're at elevated levels on the markets, and the S&P 500 was still trading at 23 times forward. So the uncertainty has just increased with Trump, but the starting point was high valuations, and therefore we believe that purely passive exposure is not bulletproof. And we don't know if we're gonna at the start of a last decade, but we definitely think that it's prudent to have an active approach mixed into your overall asset allocation. And this is what both LFG and LA are trying to achieve through different ways. LA by allocating to managers that replicate what we don't do with LFG in-house. What are the key highlights of liquid alternatives? First of all, as you've seen, over half of the investment team has basically spent most of their careers actively managing hedge fund strategies from the inside. So being in the kitchen, knowing how the sausage is made, and usually when you see hedge fund allocators at large, private banks, wealth management platforms, pension funds, insurance companies, very often they have a checkbox. They have a very quantitative approach. They look at Sharpe ratios, they look at Sortino ratios, all very nice. But when they actually talk to a fund manager, especially in the strategies that we're looking at, which are mostly bottom-up fundamental strategies that we actually understand, they don't really know necessarily always how to ask the right questions and understand where does the return come from and how is the risk managed especially. So we think we have a really unique angle here that we talk to these people as our peers. A lot of these managers, we've known them for a very long time. There's full transparency in terms of their portfolios, their underlying investments they have. We can discuss specific trades with them. Very often we find ourselves that we have some managers that have the same trade on that we have in LFG, and we can compare notes and they say, oh, this is really interesting because we haven't thought about that, or you just had a data point that is actually validating our thesis. So which also shows that there's synergies between the different verticals that we have within NOIA Capital, and that goes into the thinking of why we selected these specific verticals. So the team is obviously, I think, our main selling point. We think this is really a unique kind of starting point to be able to put together this portfolio of hedge funds. And then it's really all about alignment of interests, which that's the NOIA DNA. So what we're doing in-house is what we're looking for from our fund managers. So we like to allocate to hedge fund managers that have skin in the game, that basically are all in on their own strategy, and again, not having like different businesses where they have most of their wealth allocated elsewhere, or sitting on large real estate portfolio and then just trading around for fun. This is not it. Like, all these guys are professional, all in, they love the game. They could all retire, probably some of them, but they still show up every morning in the office and they want to crush it because they love the game and they love beating the market especially. And then transparency is very important for us. Again, it's about knowing what we invest in. So a lot of these funds, if you don't know what you're investing in, you invest based on a fact sheet and the returns and can do all the diligence you want. You don't really know what the investments are, or you have a backward-looking mirror. So we really want to get transparency from the managers we invest in so that we can understand their core positions, how they manage the risk, concentration of the portfolio, and that leads to what we believe superior return profile. So we are looking for strategies that are on the spectrum of higher returns than you'd usually see in fund of funds. There's a lot of fund of funds that optimize for very low volatility, and there's nothing wrong with that. But our DNA at NOIA, again, is more higher returns, and we're okay with some volatility, although we believe that liquid alternative is by far the least volatile and the most capital protected product of any of the NOIA products. But still, we strive for double-digit returns. So we want managers that can compound at mid-teens to us, and then net returns to our investors in the low teens. Over a period, again, assessed over 3 to 5 years, we think. Whereas for LFG, we've had a great start, and we think we're in control of our destiny, but the market can go either way. With LA, it's even harder to say, oh, well, we invest in a manager, and after 1 year, we basically have to give a scorecard to everyone, when we know a lot of these funds that we allocate to have very lumpy return profiles. So there's some funds that will make all their money over a 5-year period in 1 year, and the rest of the time, they might be flat, they might be down. So we assess the returns, again, on a rolling 3 to 5 years is probably the appropriate time horizon for a portfolio like that to really demonstrate the skills. What does NOIA LA give an individual investor? I think the biggest point to make is actually how hard it is to get access to a lot of these managers as an individual investor. Whether you do it through family office or ultra high net worth, or you have service with a private wealth manager, it's about the selection. It's really finding these niche managers that are not necessarily the big brand names, the multi-managers of the world that are running billions. It's about really finding the niche managers that have this domain expertise that we're really looking for, and then also being able to invest into them. Because a lot of these managers, they have limited capacity. Some of the funds that we're invested in are actually close to new investors, but we were able to get an allocation because we have a personal relationship with the manager, and he will say, well, all these funds always have some redemptions, so they will replace redemptions, and we're basically first in line to be able to increase our capacity. So this is really something that the product gives to us, and obviously you get a diversified portfolio. So we pick the names, you get 15 to 20 names of the diversified exposure, going through a rigorous selection process, in-depth managers evaluation, and we make sure that the funds put next to each other actually are complementary. So it's not only about selecting 15 funds that all we think can perform well, but it's obviously, and I'll go to the strategies in a moment, have like an all-weather fund where in any given market environment, some funds and some strategies will do better than others, and some strategies will outperform and others will underperform, and all in all, the funds amongst themselves are not correlated, which is very important to us again. And the last thing really I think that's also very important is, given our background and our beliefs at NOIA, we're not passive managers. We're not writing a check to 15 guys and then we check in on them once a month or once a quarter and say, oh, we've done well, or you could have done better. Why did you do this? Why did you do that? Everything we do is active. So we obviously cannot actively trade hedge funds like we can trade stocks, but there is a lot of degree of influence you can have to rebalance certain weightings, certain exposures as we get inflows. Every time we get inflows, we have to decide whether we're going to allocate the money pro rata across all the investors or not. And usually by doing that, you can basically shift the portfolio according to where we believe we are currently in the market. And if we see certain strategies or sub-strategies that we think there's some dislocation or are particularly attractive or there's been a drawdown, then we can overweight those. And we also, on top of it, have the ability to hedge the portfolio and to use futures if we feel that we're going into a really dangerous time, even though we know our managers themselves, they also will do their own hedging, but we can still express certain views at a portfolio level. And that, again, I think sets us apart from a lot of typical fund of funds. What are the core objectives of LA? First of all, we wouldn't be here if we didn't believe in active management. So we think that it is possible to beat the market and to outperform the market consistently over time. Not every year, year in, year out, but measured on any longer term time horizon. We have this conviction that by picking the right strategies, picking the right managers, and actively managing this portfolio, you can actually consistently produce equity-like returns with much reduced risk, which comes to a lower correlation. So we think we can deliver, and we're looking for performance that is uncorrelated to whatever the market does. I think it's important when you're in an uncertain environment where you don't know where equity markets are going to go, where credit markets are going to go, where commodities are going to go. You want basically, and I'll give some examples at the end of funds. You want funds that can do well in any market conditions because they're exploiting specific niches, specific arbitrage strategies, or they just really have a unique domain expertise in a very narrow investment universe that they focus on. We seek absolute returns, as I already said, that compound over time. So I said, again, the target returns that we're seeking for our managers are mid-teens through a cycle, and for the overall LA product to have low teens net returns to investors after fees and expenses. And what's also important, I'm not saying it's very easy, but it's easier to get more returns, obviously, as you go on the liquidity spectrum, if you're willing to lock up your money. But LA, as the name says, liquid alternatives is a liquid product, so we offer our investors quarterly liquidity, and therefore the hedge fund strategies that we invest in are all liquid. So there's no private equity, no private debt, no mark-to-market, no basically leftover assets. And even we've been in this industry for a long time. In 2008, we were all in large multi-strategy hedge funds that were all liquid, but there were a lot of our peers that had gotten sucked into the wave of having a small part of their equity allocation actually turn into private equity. Usually how that would happen is you'd invest in a company, the company gets taken private by a large LBO fund, and you do the math and you say, well, actually they're not offering a great premium. The guys who are buying the company are actually going to make a killing. I would actually prefer to, actually want to be able to stay invested in the company, but obviously you can't because the company is going to leave the stock market. So some of the private equity funds offered the hedge funds to roll their equity into the private equity vehicle and then be locked up, obviously, because then you don't get an exit until the private equity fund exits. And in 2008, then when the financial crisis happened, a lot of funds that had these exposures, they had to basically, when investors asked for their money back, they said, well, actually 10% of your money is in this illiquid stuff where you can't get out. So they had to gate redemptions, they had to do all sorts of things that we don't want to do. So liquidity, we think, is really paramount. And we view LA really as an all-weather vehicle where you can park your money when you don't have exciting private opportunities or higher return opportunities. And that's the way we actually look at LA in-house. It's an all-weather fund that will protect your capital, that will hopefully give you equity-like returns, and that will be decently liquid, that you can exit it on a quarterly basis. I'll skip a little bit over what we're looking for, but basically we look for managers that think like us. That's the most important. Managers that share our philosophy. So it's not only about picking strategies based on their returns, it's really all the managers we know. We have an extremely good relationship with them. We have an active dialogue with them. We share ideas, we share our deal flows. We want to invest in people for the long run that we're philosophically aligned with. That all have skin in the game. They're all in on their business the same way we're all in on NOIA. And that compound at the same types of returns that we're looking for. How do we deploy the capital in LA? Concentration, name of the game. As for LFG, we don't believe in managing a fund of funds with 40 or 50 names. I don't think it would be practical. I don't think it would be necessarily adding any incremental diversification. 15 to 18 funds is the sweet spot right now. I think we have 16 in the fund, down selected from over 200 plus funds that we review and filter on an annual basis. We go deep down on the manager evaluation, and we basically then overlay on top a tactical asset allocation when we go into how we allocate the funds. And this is basically how we look at the universe. So we have 4 buckets where we classify the funds and the strategies that we invest in. First bucket is equity strategies, self-explanatory, equity long short, can be long biased, can be long only, but usually contrarian people. Most of the funds actually that we're allocated to have a niche that is either geographical or they also only invest in smaller to mid-cap. Usually we look for the spaces that are less efficient, and they usually also have a concentrated portfolio like us. Credit strategies, this is usually opportunistic credit, stressed, distressed, and some capital structure arbitrage, fairly technical. We think the current environment, obviously credit spreads are at all-time lows. There hasn't been much distress, so it's not been the most lucrative hunting grounds, but we all know that if and when there is a credit cycle or financial conditions tighten again, which very well may be the case, and or you just get idiosyncratic industries that get affected by political decisions, there's always something to do in the credit space when you're an expert, and this is something that is heavily relying on legal analysis, balance sheet analysis. Really, it's a craft. I've done it myself for quite a while. There's not a lot of people who really know their stuff, and the managers that we invest with, they're really experts in their field, and it's a good balancing strategy to the equity strategies. Usually, when the equity market doesn't do well, the distressed cycle is doing well. Macro and commodity strategies. And we have also some systematic strategies in there. So these are, again, strategies that should do well in any environment. They trade rates, they trade commodities, futures, indices, and some systematic alpha strategies that I'll go into that basically just exploit market inefficiencies across different asset classes. And finally, event, which is an area where most of us come from, actually, so it's a strategy that we understand extremely well. Those are funds that focus on companies that are undergoing transformations, mergers and acquisitions, selling of a division, holding company trades, complicated capital structures, or where there's an activist that came on board and is shaking up the management or the organization.
If you can just go back, Manfred. So the interesting thing, for you to know is in NOIA LA, we did what we have done at LFG as well. We kept the minimum investment at the regulatory minimum that is required in Luxembourg, which is $100,000. LA is a dollar fund, LFG is a euro fund. So with putting $100,000, you're basically exposed into 15, right now we have 16. We will be between 15 and 18 funds. You will be exposed to 16 strategies that are an amalgamation within these 4 universes, basically. If you guys were to say, oh, no, I want to do this on my own, with me, as me personally, with my private bank, or even as my family office, the funds, as someone else that wants to do that, you would have to take 20, 30, $50 million to be able to go above the minimum thresholds for those required funds. And you would have to find the funds, do the analysis of the 200 funds that we've looked at, and then be able to find the funds that are actually able and accepting your capital, right? Because as I said, we have already 3 or 4 funds out of the 16 in the portfolio that are now closed, that nobody else can come in, basically, right? So this is really the value add that LA is giving to every single one of you, which is how we wanted to deploy our capital. We seeded it, and now we're accepting this. If you actually think of it and you go out, you put $100,000, it's divided by 15, you're basically investing $7,000 clips into hedge funds. That's unheard of. That's like retail level, basically, exposure to really, really high quality managers, basically, right? That's really what we're doing in the LA, and Manfred will now show you a couple of examples, basically.
Just to make it a little bit more tangible, this is a fund based in the US called MNC. They're high frequency traders. The fund was launched in beginning of 2024, so we're invested basically almost from day one, everything from day one of our fund. They started with $20 million. They're at $150 million right now. It's a team that basically comes from data science and quant approach across different asset classes, have traded any market structures in the past, and they returned 40% net in 2024 with only one negative month. So basically being able to generate returns in any market environment, and down month was down 10 basis points. So and this is a team that actually has been running this strategy in a previous outfit that we've basically known some of the team members when they were launching the fund. We had conversations before they launched the fund. We knew their track record. We knew basically that they were high quality people, and so we're basically excited to back them day one with their strategy, and they've done extremely well, and we think we'll continue to do well. RPD is another interesting example because this is actually a sister fund, so to speak, of a very established long-short equity fund that we also looked at, run by a seasoned equity long-short manager in New York who's been doing this for 20 years with a very good track record, bottom-up stock picker, fundamental guy who, again, we've known for a while. And we were particularly attracted, though, because the long-short equity strategy was quite volatile, and even though we believed it was a good stock picker, we basically didn't see the need to add a significant amount of these equity long-short managers into the fund. But he basically realized that he was very good at trading options within his long-short strategy. And so he created a separate vehicle 2 years ago in February 2023 that would basically focus just on trading options on the stocks that he knows well, which is basically generating income premiums, so selling options every month and rolling those options on stocks that he knows well, usually widely out of the money, so 30% out of the money, and basically saying, okay, I'm happy to own this stock. If it goes down 30% from where it is, then it's a great entry price. And that is basically a very low volatility strategy. Again, in 2 years, annualizing over 10% net, with the worst month being down 10 basis points. And this is actually a strategy where we had discussions with them and we said, we think the strategy is great, but I would actually love, because of your return profile and volatility, I would love to leverage it up, but I can't. And so they just launched an enhanced version of the fund where they use modest leverage, which we think should basically bump up the return profile from low teens to mid-teens, which fits very well with our profile of strategies. Again, uncorrelated. So even though the underlying is equities in the US, predominantly a lot of like S&P and NASDAQ stocks in there, but in months where the NASDAQ was down 5-6%, this guy would be up 50 basis points, 70 basis points. So he benefits from volatility, and actually the more volatility, the more premium he collects from these option strategies. And then finally, another example of an event-driven fund, and we've been in the event space for a long time, and this is somebody who basically, after looking at the whole space, I found very few event funds that we really liked, and this is a guy sitting in LA who's been doing this for 20 years, or in California to be precise, who's been doing merger arbitrage and event all his life, has pretty much all his money in the fund, started small, ran it up to 750 million, and he's been basically annualizing a 20% net return since 2011 with no down year. But intra-month he can be volatile, which puts a lot of investors off. But because of our understanding of the strategy, we could go in and understand, okay, what happened in different months. He's very concentrated, and he has a very differentiated approach to most event-driven merger arb guys who are very, I would say, risk-averse and manage their volatility on a month-to-month basis, and they cannot stomach to have a month where they're down 2% or 3%. And this is basically somebody who has a very different philosophy, and that's allowed him to, while basically knowing what he's doing, having the advantage of having a time arbitrage and saying, okay, I don't care about month to month, I care about what's there at the end of the year, and he's at no down year in basically 13 years. And he applies an event lens to stocks that are actually not on the radar of a lot of event-driven funds, which is very unique in the way he does it. So these are just 3 examples of some strategies that we have in the fund. We usually don't disclose the names in like public documents, so this is just for the purpose to make it a little bit more specific. But obviously, to all of our investors, we're always happy to give full transparency about the managers that we allocate to and what they're doing. But I hope this gave you a little bit of color, and I'll give it back to Mo for the takeaways.
For the regime change and for the key takeaways. So I think it's clear now overall that we as a firm, we believe that we might be at the precipice of a regime change, right? And therefore, this is something that I want you guys to also think about. We obviously don't claim absolute knowledge. Obviously, we don't know. We're just, looking at things the way we would want to run our money. But this is one of the key takeaways. The second one is that NOIA LA actually allows you to have this diversified, best-in-class exposure to these various managers, which is really, really difficult. I don't know any other product that is out there that would give you the same. I mean, if there is anyone, I'd be very interested to find out. And then the last one is that these absolute return strategies, they should be in everybody's portfolio, right? I mean, even if you have a long-term view, like Yunus said with the snowball effect, and you say, okay, it's fine, I'm going to stay 10 years in the markets, etc. To have part of your portfolio in absolute strategies is just an enhancement of the return profile of the portfolio. So it's just something that you guys should all consider, and it would be amazing if you do consider that as part of being with us on the journey. I think we have a coffee break now.
Yeah, I think I just wanted to add just one thing more. I think the way I personally look at LA is to be taken into consideration with the rest of the scope at NOIA, in the sense that I think you mentioned cash park at some point, Fredo, but this is really an important aspect of our strategy, in the sense that markets are not always going to be up. There's not always going to be an appropriate context for direct deal making. The crypto is not always going to be the moment to add new capital to, and therefore this is the ideal strategy for us to actually park our capital, which is why we insisted on having quarterly liquidity, so that when the market is turning or when there's a change of paradigm, whatever asset class we're referring to, then we can basically pile back into those when appropriate, while having those equity-like returns but uncorrelated. And that's really the second aspect I really want you to have to take away is, I think, again, coming from a 10-year bull market, I think we've starting to see a lot of volatility in the last 2 years, and just being long equity, passive or not, I think it's just people have gotten probably a bit too comfortable being long equity, and that's it, right? Bonds have dropped out of portfolios, real estate market has not been great, and therefore people have just been accumulating more and more and more equity exposure, and at some point there's a limit to that, right? And I personally, at least for my benefit, see this as just an alternative to just being long equity overall. So I think this is it. If we'll take again
some questions?
a couple more questions.
Please.
It's a quick one. It's more about on the definition of this as being a liquid fund. So my question is it because you're seeking to only invest in funds that will pay back to their investors quarterly something, or are you calling this liquid because of how the end investment is structured, as if like a credit structure or something like that?
So the end managers, the AUM that we have, we allocate right now to 16 external managers. Every single of those managers gives us quarterly liquidity. So every 3 months, we could say, I want all my money back, basically. So if I've invested $5 million into Barrel, I'm just making it up, I could tell Barrel quarterly, I want my money back, and they would pay me back within 3 months. And because we have quarterly liquidity from our investments, we give quarterly liquidity to our investors.
So you are able to find funds that are even driven, that are doing this kind of more.
We ignore anybody that is above 3 months, correct? Yeah, that's on purpose. Because like Jerome said, it could be an environment, and Jerome will go into the direct deal. Sometimes from some of our private investments, we get very excited. And sometimes when we get very excited, you want to take outsized bets, basically, right? And if you want to do that, you need to have be able to take the liquidity from somewhere. And that's why think of like you want to allocate to private equity, and they have a 3-year allocation period, and then a 7-year harvesting period. So they give you your money back in 10 plus 2 years, basically. But in those 3 years, you know they will call your capital. So in that period, if you've decided you want to put $10 million into a private equity strategy, you need to keep that 10 million ready over the next 3 years. But you don't need to be liquid. Like, it makes no sense for you to just sit on 10 million for 3 years to wait. You could allocate it, for example, in LA, and then know every 3-6 months, I will start calling my capital back, basically when I'm getting closer to the calling period, because I need that liquidity to invest it elsewhere. So it's like a parking lot. Think of it like that, exactly.
Look, for us, this isn't the most exciting product, right? We get much more excited by volatility in the market of small caps, crazy drawdown on crypto from one day to the other, or distressed a direct deal, buying an asset off the shelf because somebody needs to get rid of it, right? That's really most 90% of our time we'll dedicate to that, right? Because that's where most of the value will be for NOIA. But this is still an amazing product for us to be in. And on top of that, just if you forget about NOIA just for a second, right? I mean, we don't have exposure to other managers outside of NOIA, right? I don't have any other exposure personally to any other manager, and I want to have some exposure, right? I don't want to be fully concentrated in our strategies. I mean, maybe we'll be wrong one day, of course. You know, we will definitely be wrong at some point, and this is also a hedge for us as well to some extent. It's both a cash park, a hedge, and access to liquidity, like I said, right? For
I'll be happy to disclose. I came into this year of 2025 looking at it personally, thinking, okay, we had an amazing return in markets in 2023, which followed with a bit of volatility, but an amazing outcome and an amazing returns in 2024 again. So Nasdaq did 50%, 55% in 2023. It did another 20-25% in 2024. So I was like, okay, we've come a long way already in 2 years, basically. So I allocated personally a significant chunk to LA, thinking, okay, I don't know what markets are going to do, but I'm comfortable being with these 16 managers that give me quarterly liquidity, so that if I see any change in regime and I want to redeploy, I can then take from NOIA LA and I can put it into NOIA DA or into NOIA LFG, basically, or elsewhere, obviously.
I did exactly the same.
Yeah,
so
Jerome did the same.
one week after the U.S. election, or Trump coming into office in January, I basically sold out of all my large caps, all my equity stakes from one day to the other, and I basically bought back into this because I was just conscious of the risks, and large caps being priced to perfection and trading at 25x their earnings gets me in a bit of a nervous position, and I was basically happy to cut off that risk and try to get equity-like returns through LFG, but without the drawdown. Remember, we have 4 different categories of managers, right? We have equity exposure through the equity long-short equity managers, but the hope here, or what we're trying to build here, and this is how we build a portfolio, by adding credit strategies, by adding macro managers and event-driven managers, we hope that when the markets will go down, that the other managers, the other categories outside of equities, the other 3, will compensate for that.
For example, we have a macro manager here that we believe in the month of March, this month, where a lot of equity guys are suffering. We believe they might even print double-digit returns, but they'll be high single-digit. We just had one other macro manager that we had passed on, who's already told us last week he's up 18% for the year, basically, right? In a market that's down quite significantly, right? So this is built, LA is built in a way where you have inherent hedging within the different managers and the different strategies, basically, right? But we're not just focused on that. The most important focus is that the manager itself is really good at what he's doing. That's the most important, basically.